Equity repurchases. Why do they do it? Okay, I call equity repurchase, first of all, before we get into why, the dividends of today. So, a lot of companies, these are modern day dividends. Because really, if you think about it, a dividend is a way of returning wealth to your owner, the owners of your company, but equal, an equally effective way of returning wealth to the owners of your company is by simply repurchasing their shares. Well, why did it become more common than dividends? Why are dividends disappearing? Right? I don't think they've made a comeback. They certainly started falling out of favor in the late 90s and the early aughts. And really, repurchase programs took over as the main vehicle to return wealth to shareholders. Firms might just need some shares in order to satisfy pending option requirements. What are pending option requirements, right? So if there's employee stock options, that means that your employees have the right at the moment of their choosing to buy a share of the company's stock at a predetermined price called the strike price, right? So understanding that there's this potential for company employees to buy a share of stock, that means that the company has to have a share of stock ready for that company, for the employee to buy. This is one way that companies will fund those programs is by repurchasing shares from owners that are not employees of the company. They might be repurchasing shares in order to adjust their capital structure mix. So this would be wanting to reduce the equity portion of capital stock, right? Sorry, the capital structure. So there's really two pillars of capital structure. There's the liability portion, right? The amount that belongs to creditors through bonds, things of that nature, right? Creditors versus the owners of the company. Maybe they overdid ownership. They issued too much stock. They want to reel it in a little bit to reevaluate their capital structure. They could think that the shares are undervalued. This is called a signaling hypothesis, or not called, but has been called signaling hypothesis by researchers. And the hypothesis is, or what underpins the idea that was suggested by researchers and makes a lot of sense, is you're not going to buy something that you think is overpriced. And so if the company is making a commitment to repurchase its shares, then that means the company might have some inside information that the current market price of their shares is too low, right? They're not going to buy shares if they feel like, oh man, the investors, I don't know what they're thinking about our future and our options, what they're speculating on. But man, those share prices are high. Let's buy some. Absolutely not, right? You're only going to buy things that you think are a good deal. And if our stock is a good deal, that means it's underpriced in the market. Finally, there's a substitution effect, right? What I said, basically, it's the modern day dividends. Companies like repurchase programs rather than dividends because they tend to be more flexible terms. If a company starts paying dividends, they better not reduce the amount of dividends they're paying per common share, and they better not skip a dividend payment. Those two things send ripples through the stock price and the trading of a company's stock. And that is the last thing a company wants. So they instead like to use these repurchase programs where they can say, hey, we are now going to repurchase up to 1 million shares of stock and at this price over this amount of time. I mean, there's different types of share repurchase programs, but they represent a far less steadfast commitment to investors. And even if they commit to say, even if they open a repurchase program for 1 million shares, they can stop it at any point. They could be like, oh, you know what? We bought 700,000. We're good. And investors do not have that negative reaction they do to dividends being reduced or skipped. So that's a lot of the reasons why firms do it. One more reason, and it was more prevalent maybe in toward the end of the last millennium than it is now, but it still serves a purpose. This can hinder takeovers, hinder a hostile takeover. And a hostile takeover is when, another entity is coming in and buying up shares of our company's stock to try to get significant influence over the ownership of the company to either control it or to have enough influence to make huge changes. The way that it can prevent that is basically the idea if I start a repurchase program, the people who would be most likely to sell to an entity trying to conduct a hostile takeover will sell to our company first. We can take those shares out of the pool of shares that the people running the hostile takeover could have gotten. So overall, how do investors interpret it? So basically, on average, share prices go up when firms announce repurchase plans. However, if this is more mechanical, if it's more something about the firm trying to satisfy the option of its employees so that they have additional shares of stock and they don't want to issue new shares, then it's not as likely to cause a significant price response. But on average, yeah, it's not a bad thing for the stock price when repurchases are announced. So even more incentive for companies to repurchase.